Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Seattle Investors Club podcast, where we talk about the nuts and bolts of real estate investing. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I am good in the hood, Joe. Getting ready to go camping today.
Yeah. What hood are you going camping in?
We are going out to the Coho campground, which is somewhere out past Aberdeen, heading north to, I guess it's a national park. I'm one of three families with a bunch of 7 kids and a bunch of adults and all the good fun stuff that we need to haul along with us. So I am looking forward to that. I think you're rubbing off on me, Joe.
I love it. We'll both be in national parks this weekend.
That's right. So I think all you guys know, because we talk about it every week, that Joe is off on his road trip, checking out all the national parks he can over this year. And where are you at today, Joe?
I am right outside of the Badlands National Park in South Dakota. And if you've never been to South Dakota, I never really had a need or want to go to South Dakota beforehand, but there is some really cool stuff here in South Dakota. Big caves or, cool geological features, lots of places to do hikes and trail runs. So I'm a fan.
Are you guys picking up a souvenir of some sort from each of your adventures?
I was out on a run this morning and I saw a rock that looked really cool and I thought about picking it up, and then I realized that my van is not very big. So
that's right.
The only souvenirs that we're really picking up is we buy the sticker that has the national park letters on it. So if it's like Badlands National Park, it'd be like BLNP. So we buy one of those that we stick on the box, the trailer hitch box that we have.
Nice. That's cool. Yeah. I like. Well, because we're all on the road and excited to get out in nature this last weekend before school starts for us, let's jump on into it, because we have some great information today that we definitely, all of us real estate investors and builders and realtors, we all need. It's a great time to check in. It is August 30th right now, 2018. This podcast is a little bit of a delay by a few weeks. So hopefully you guys are going to find this podcast very helpful as you kick off into 2019. And Joe, who are we talking to today?
Yeah, so this is going to be a really fun one today, guys. We have a real estate analyst, Todd Britsch from Pacific, who is the Pacific Northwest Regional Director of Metrostudy. So Todd, welcome to the show. How are you today?
I'm doing great. Thanks for the invite.
Awesome. So, and Metrostudy, if you guys don't know what Metrostudy is, I'm just going to read what it says on your website there, Todd. It says, Metrostudy provides housing market intelligence, proprietary research and analysis, and consulting to industries that seek to minimize risk and grow revenue. So we pretty much figured that sounds like us, guys. So we're going to talk to Todd. Sound good? Let's do it. Let us do it. So Todd, thanks. And you're in the Seattle area too, Todd, right?
I am born and raised.
Born and raised. So we usually kick it off with a little bit of background. Joe, I'll let you kick us off about Todd.
Yeah. So the first question, Todd, is always just, how did you grow up? How did it lead you to where you are today, and any fun things in between that we should know about you?
Yeah. So it's been an interesting journey to get to where I'm at. We lived out in Black Diamond when I was growing up, and my mother started out as a cleaning lady in an apartment complex, became a rental manager. A year later, started selling condos, started selling houses, and then by the time I was 7, she was starting a sales and marketing company with a gentleman here locally who just retired in the industry not too long ago. So for me, growing up, ultimately I'd sit around the table with my mother critiquing floor plans and looking at subdivision work. And to give a history on my mother,
Love it.
With her consulting, she worked on every master plan in the state of Washington. So Snoqualmie Ridge, Issaquah Highland, Redmond Ridge, Campus Highlands. I mean, you name it. She worked on them. And a lot of these subdivisions, they're 8 to 10 years in the process. So when I was 12, we were working on Campus Highlands. When I was 16, 17, Issaquah Highlands was laid across our kitchen table. And I just became completely engrossed in it. And then in 1995, I had worked for her right out of high school, gathering some data for consulting work. And as we moved into 1995, one of the employees at the company said, hey, there's a whole World Wide Web thing coming, and I think it'd be cool if we captured all this data that we gather and threw it up on a platform. And I would venture to say, I don't know this to be a fact, but I would venture to say that we were the first real-life, up-to-date data provider on the internet, being that we were up on the web within days of the internet going live.
Wow.
And
I just got the chills.
It's kind of cool. I left the industry for a number of years, went off into grocery, but still swing by my folks' office and kept bugging them. You got to hire me. I get this stuff. I understand it, and I see the value in it. They were thoroughly convinced they were going to raise a ton of capital. And then the dot-com crash came, and my father never was able to raise the capital just from, just basically being out of his skis on that one. And they were going to shut the data side of the company down.
Wow.
It was producing $300,000 a year in revenue. And I finally convinced them to bring me on board. And in a matter of 36 months, I grew them from $300,000 to $2.5 million in revenue.
Wow.
And then took over the company in 2000.
Wow. You guys like the first Zillow.
Yeah, I wish I had a little better skill set at that point in regards to growing a business, because I think if I had been there prior to, say, 97, I might have been able to get that capital to do some of the Zillow stuff. But yeah, it was a fun time growing the company. And then my father passed away 4 years ago, and it was time to sell the company. So we sold off to Metrostudy, and I still work for them while doing some other things in the local area, including building and real estate investment and commercial development and all that stuff. It's
addictive. I always find that if you get into the real estate, if you touch it in any way, I mean, it's just addictive. It's such a passion. It becomes a complete lifestyle. That's how, I feel my kids are experiencing in a different way the same thing you experienced, right? It's real estate mom, and they know about it. They, are engulfed in it as well. And I love it. That's a great story.
Yeah. My oldest, who is now 24, is a realtor.
Wow.
And he works for, I have a real estate brokerage as well. So he works for my real estate brokerage.
Oh, which brokerage?
It's called LandLink.
LandLink. Okay, cool.
Small.
Is that more commercial, or is it?
Land primarily.
Oh, I guess that makes sense, doesn't it? LandLink.
We do a lot of subdivision work and raw land sales and stuff.
That is great. And you guys are brokers, not just working for your own account, right?
Yeah. So I'm a broker, and then I don't do a lot of stuff. I do a couple transactions a year, but then I've got 2 or 3 brokers that do anywhere from 5 resale jobs a year to 10 million in land deals.
Nice. I spent myself a few years focused 100% on land transactions to, institutional types like Lennar and, equity and those things. So I was deep into it for years, and I spent the first 16 years of my career working at Goodman Real Estate for John Goodman. Do you know John?
Yeah.
Yep. So I'm been around the block. I learned all my chops from him back in the day, or he threw everything on my desk, and that's how I grew up. So it's all very interesting to me how it all connects back around at some point.
Yeah.
Interesting enough, when I was at Goodman, I felt like after I left there that I know way more now than I did when I was there. I knew how to do what I did perfect. I was really good at it there, but it was a lane, right? So in some ways I enjoy, having this global real estate knowledge, putting it all together. I guess I don't call myself even a broker. I call myself a transaction facilitator, right? Because I just been around a bit, but good stuff.
That comes with getting older too.
Hey, you weren't supposed to say that.
No, it's just me and my personal experience. I thought I was good. I thought I was good at at 34 doing this, and I look back now being 50, and like I am a hell of a lot better at it today.
Exactly.
But that's the way it's supposed to be, right?
That is the way, yeah. And then we're still surviving and we're still going, so that's good news, right?
Yep.
Yeah. So let's kick into the info and keep rolling here. I could be wrong, because I don't really run necessarily with a bunch of builders, but my transaction coordinator does, and works for a few builders agents, I guess I'll say, plus me. And I'm hearing a little bit that there's a lot of renegotiating going on. Some of the builders that are, have a full plate might be selling off some of their stuff and maybe taking a pause just to assess, not a stop, but maybe just a pause and an adjust and a look before pushing hardcore through forward. Is that anything that you're hearing? Maybe that there's some regulation that they're waiting on. I don't know. Fill us in on what the truth is there, or what you know.
Yeah, I think there's some truth to that, and a lot of it's my fault because I do a very large quarterly briefing for a good chunk of the builders within the greater Puget Sound area and the Portland metro region.
Is that at an event, or is that on a newsletter that they subscribe to, or what is that? Is that through Metrostudy?
Yeah, so Metrostudy is basically a subscription-based product where you get online access, and then you get access to me. And where I live all day, every day is neck deep in the housing data.
Right.
Whether it's resale or new construction, foreclosures, land sales, absorption rates, trending information. It's all I do all day. So a couple of quarters ago, we started talking about when the environment that we're in today was going to happen. More specifically, I started talking about the possibility of it 2.5 years ago and why it was going to happen. And where we're at. And essentially what it is right now, and I know there's a lot of nervous, gut-wrenching feelings out there, especially for a lot of folks that are in your boat that have just gone out and probably in the last 3 months have got into a bidding war on a couple of homes, and then it's like, okay, my gut doesn't feel so good right now.
Right.
And there is a correction in the process. And there's a number of things that have occurred to cause this to happen. And there's almost 3-4 things all hitting at once.
What are those?
Well, first and foremost, the head tax against Amazon and the other large companies in Seattle. What Seattle City Council did was, I don't want to use the word catastrophic, but very effective in what their goal was to slow down the impact of cost of housing.
Meaning scare the S out of people?
Yeah, pretty much. So you look at these large corporations, and the Seattle City Council is still in the mindset of, we want to give roofs over the heads of all these homeless people. We want to give them a safe place to do their drugs. We want to put food on their table so they don't go hungry. They're the perfect enablers on the planet. And they're going to extract that money one of two ways. It's either going to come out of the taxpayer or it's going to come out of the corporations. So the large corporations now, I can tell you as a business owner, if I were in Seattle and I was running a large corporation like that, I'd be looking for an exit strategy.
Right.
Or I'd be hiring lobbyists to outroot every single one of those Seattle City Council people. The notion that Seattle is not business friendly is absurd, because the general populace is all for the business growth in Seattle. It's just these few city council members that we have now that are trying to fix their problem instead of managing their monies better. That's one. So there's let me preface this. I don't say this as if Amazon's going to pull out of Seattle, or Zymogenetics or some of these other large companies are going to pull out of Seattle. I don't think that's the case. However, if you're an Amazon employee that was recently hired and you have an option to go to the second headquarters, or your management and you're looking to move those individuals off to second headquarters, they just absolutely put a pause on the home buying.
Right.
They don't know if they're going to move off or not. Simultaneously.
Well, I think also what that did from my perspective, because do a lot of brokerage, residential brokerage right now, is it caused buyers to be afraid to pay top dollar or full market price for the homes.
Right.
Because the uncertainty, there's just uncertainty. Maybe the answer wasn't, oh, this is going to happen, but it was like, oh God, you mean they're talking about doing something like that?
Yeah.
I mean, and it just caused people to think that, well, it might be okay for now, but buyers, which is all this is about, buyers' perceptions, might cause the market values to go down. So I don't want to pay full top boat. I tell all my flip friends that flip houses and stuff, you might want to start thinking about leaving something, for the buyer to finish, or at least a perception that if the market goes down a little bit, all they have to do is finish that bathroom downstairs and they'll get some market value back, rather than trying to give them a perfectly finished, blinged out house that they're scared to buy because they don't have any equity left and they think the market's going to go down.
Yeah. The perception here too is people think back to a recession of 2008 to 2011, essentially 2012. That was not a recession. We were so close to tipping upside down. It's unbelievable. Most people are completely unaware. They just think it was a great housing recession. While it was, when you look at all of the fundamentals that created the housing collapse, those fundamentals are not anywhere in existence today.
Right. And I think people know that. Like my feeling, I'll say from being on the streets and having conversations, I feel people know that and they're more scared of other things than that.
Yeah. And I think it's more fear of the unknown.
Right.
I will say this, that my only large concern right now is the corporate bond market.
What does that mean? How do you?
When you look at, and I do this as, I'll phrase this as simply as possible, and that's not for your listeners, that's for my benefit. I do not have a college education in economics, but I just study the crap out of them. Quantitative easing ended in October of 2014. And that's where the Federal Reserve was essentially buying all of the mortgage-backed securities because there wasn't a secondary mortgage market after the crash. Well, that ended 4 years ago, and consequently, Freddie and Fannie have been sitting on a good portion of their mortgages that they've been holding, and they hold the vast majority of all mortgages written. And you flash forward to about a year ago where the Federal Reserve started liquidating hundreds of billions of dollars of mortgage-backed securities a month onto a secondary mortgage market. Well, now you've got 4 years later, you've got Freddie and Fannie have now seasoned some of their loans that they need to move off onto a secondary mortgage market, and they're doing that. At the same time, we have Treasury bills that are hitting the bond market, upwards of $1 trillion. This year. And it's a very small bond market, if you will. So consequently, when you have that much inventory out hanging in the bond market, then there's discounts on those bonds. And we see rates start to increase on those bonds, which is why now we're getting dangerously close to an inverted yield curve on a 2 to 10 year Treasury note, which has been a real source of prediction for a recession. An inverted curve is where you're getting higher yields on a 2-year bond, treasury bond, versus a 30 or a 10-year bond. And the spread right now is at 0.22%. You go back a year and a half ago, it was about 1.5%. 2 years ago, it was 2.5%. When that becomes inverted, there is a recession to follow. Now, it may be 3, 6, 12, 15 months away, but it's predicted almost every recession since 1970.
Yikes.
Now,
what is a recession going to look like in this next phase of recession that probably is inevitable?
Right. So this gets into the corporate bond side of things. So with the Federal Reserve consistently raising rates, and they're going to raise them 2 more times this year. They've already scheduled one for 2019. The bond rates continue to rise. So from a corporate standpoint, on the corporate bond level, that you're looking at the amount of interest that corporations have to pay to borrow money is rising fairly quickly. And when you do that, that starts to erode profits. When it erodes profits, then the stock market takes a hit, let alone when the bond market just starts to go nuts anyway. If you remember probably 120 days ago when there was a hiccup in the bond market, just by treasury notes jumping up, I think, a half point, it threw the stock market into chaos for a couple of weeks. Well, that's going to happen again, I think, as we move into 2019, somewhere in the third quarter of 2019.
And how is that going to trickle down to, like, affecting the builders and the home buyers and our crowd? Is it going to, obviously the rates, whatever happens with interest rates, or how does that translate into a direct impact on us?
So one, it starts to erode consumer confidence when the stock market takes a little bit of a turn, which it's going to. You can't continue this exponential pace of growth that we've seen for essentially 8 years now, I think is what it is. It just doesn't happen. Cycles occur within housing, within the economy, the stock market, all of it. And it's typically about that 7 to 8 year cycle. We are in the longest growth longest economic expansion in the history of the U.S. It's going to break. It's not going to break bad. This is a soft landing. This is what I like about this recession. They happen. So kind of think 1986, think 2000. Even after the dot-com crash, housing exploded. So recessions don't always necessarily mean there's a depression in housing. However, job growth does. In migration, those two things within a geographical location do definitely impact housing. And we are seeing our annualized job growth numbers come down. If I look at the fourth quarter of 2017, our annualized job growth was 60,000 new jobs. First quarter, it was 33,000 new jobs, roughly. Second quarter, it was 22,000 new jobs year over year. So our job growth is definitely slowing. Unemployment is sitting in the mid 3s to low 4s. That's full employment.
Why is job growth slowing? Is it technology taking over jobs?
No, I don't think so. We're a very tech-oriented geographical region with Amazon and Google and Microsoft, obviously, and a slew of other companies that are within the Puget Sound. We're the new tech mecca of the West Coast. So the growth in technology obviously helps the Pacific Northwest. What's happening now is, and this occurred a year ago, Amazon was pretty close to fulfilling all of the jobs that they had in the Pacific Northwest. Now, it's my understanding, don't quote me on these numbers, that they were about to add another 20,000 jobs, and then the head tax came through, and they decided not to fill up that tower in Seattle. I think it was the Rainier Tower. They did lease some space in Bellevue, but they may not bring those 20,000 jobs here in the Pacific Northwest. They may reserve those for the second headquarters. I just don't know. They're very close to the vest with all of that information. But the tech sector in the Northwest has essentially leveled off in regards to its hiring. And that was where the vast majority of our growth has come from in the last 5 years. We've added, since 2010, 933,000 new drivers to the state of Washington. About 67% of those come into the Puget Sound. That's why it's a little bit harder to get around these days.
A little.
And that in-migration has slowed. Last year, it was an average of roughly 11,000 people. This year, just the gross in-migration. The gross in-migration this year is averaging at about 7,500 to 8,000 people per month. So the in-migration number is slowing, meaning we're not attracting as many new people into the state. Now, that said, that's not necessarily a bad thing either. There's still a pent-up demand. When I do the math of the number of people that migrate into the state, 1.78 income earners per household, 60% home ownership, and you do all that math, calculate it off on the number of homes that have been built over the last couple of years and the shadow inventory and everything else, it creates a number for roughly 35,000 owner-occupied homes still in demand. Now, that gets into the next scenario, which is urban growth boundaries and growth management, where we don't have any buildable lands left in King and Snohomish County. So we're not adding new inventories into the marketplace. All we're doing is extracting inventory. So from a supply and demand, economics 101, at the end of the day, there's really no room for a housing market collapse here per se.
Right.
We did.
But again, it comes back to, like you said, consumer confidence, right? And even though that it's almost to me like the buyer perceptions seem to be driving my world a little bit, right? It's on one side, or it also on the seller side. I actually think it's good news for real estate agents. I think I'm even feeling it in my own business. People are like, well, I think we hit the peak. I'm going to sell now before things go down anymore, right? Or they were holding out or something, and now they I better get going. Rates are rising, prices are falling, and I think we're going to see listings pick up, right? But we're going to see them pick up at a somewhat adjusted price, because on the flip side, you have buyer perceptions. And I could be wrong. I'm just talking of feeling it because I'm in the mix of it every day, where they have the money, they want to buy, they don't want to compete, and they will pay full price if it's the right price and it's not aggressive. But the moment they think they have to compete, they'll sit on the sidelines. They don't want to do that. And, for builders, again, it's, I think, a price adjustment because there's no room for improvement. Whatever they're getting, it's 100% done. There's no improvements. They're paying full price. All the equity is out of the thing, starting out. So they're backing down. They're scaling back on the prices a little bit. I that's my read. I could be wrong.
We're not going to see a huge price deduction from new construction. And the reason is because when you look at the lot supply, so you go back to the Great Recession, the lot supply back then was essentially of recorded lots was somewhere around 6 year supply of ready to build vacant lots. Today we're sitting at anywhere, like Snohomish County only has a 12-month supply. Mm-hmm. King County has an 18-month supply. Pierce County, a 20-month supply. That's a normal level. From number of homes under construction, there are 2,000 new construction houses that are under construction currently. You go back to the 2007, and there were close to 7,000 homes under construction.
Yeah,
night and day. And it was interesting. So I read this article through CNBC, and I think I saw one in the Seattle Times. It was, inventory's up 41%. And I'm looking at numbers, and I'm like, who the hell said that? Because I got these numbers plastered all over my computer. So what they were referring to, which they were completely vague in the article, was months of supply. Months of supply rose by 41%. Here it is. It's an alarming number. It went from 1.2 months supply to 1.7 months supply.
Yeah, exactly.
I'm sorry, but holy crap, can we quit the hyperbole?
Right, but that's what the average person who's not a builder, that's just a buyer or a seller out there, they hear that, right?
Yeah.
And that's it, right? It's not a big change. There's, there might be a little bouncing around a little bit, but yeah, there is no dire emergency necessarily going on here. But that, even if that's the fact, it's the perception of the average person that doesn't follow this and just hears the news that drives some of this bumpiness, right? And then what happens, in my opinion, is then you get these brokers that are part-time brokers or whatever they are, and that are not necessarily 100% in touch or are busy, but not, I don't know. And they panic. And so they want to stay in the good graces of the sellers. So they actually perpetuate the problem, is what I think I'm seeing, because they get worried. So they talk the sellers into these lower prices so they can look good and get that home sold for the price that it was listed at, or maybe even 10 grand over or something. And that the brokers perpetuate sort of a price drop on their own by not controlling the conversations and calming everybody down. I feel like I'm seeing I think like from the standpoint of people who flip houses and stuff like that is, we're not, like you said, we don't have a bunch of necessarily bad news coming our way, but for people that flip houses, the margins are not very wide. So even a 20 grand hit or adjustment or, needs to be recognized as paying attention. Again, for, like you say, for the builders, maybe the outlook is, it's not a huge hit there or whatever, but,
well, here's kind of a little stat that most people are just unaware of. You see interest rates rise, and okay, well, the payment on that house has gone up $300-$400. Okay, people can afford that. Here's what happens though. So let's go back to, say, the second quarter of 2016. Interest rates were at 3.41%. The average closing price for a house was $450,000. Now, assuming the same criteria for the next 2 years of data that I'm going to explain here, let's make the same assumption that everybody has no debt and they put zero down on that house, just for the sake here. The payment on that $450,000 house was about $2,500. The income required for that was roughly $97,000. Now, you flash forward to the second quarter 2017. The median close price for new construction was $491,000. Interest rates, instead of 3.41, were 3.93. That creates a payment of about $2,800 a month. Income required on that went from $97,000 to $110,000. Now, second quarter 2018, that median close price average for the Puget Sound went up to $581 from $490. Payment went to $3,394. So my income now to qualify for that house with zero debt is $135,000.
Right.
So our home prices in the last 2 years have gone up on average 29%, but my income had to increase by over 40% to keep up.
Problem. Yeah.
So we've eliminated a ton of those buyers. Now, if we look at where the vast majority of where those buyers were in 16, 17, and the first part of 18, they were all coming into the state in migration. It wasn't that Burger King manager all of a sudden got a 100% increase in pay. It was all of this in migration and these tech jobs that were coming in. Now those have slowed down. They slow down, immigration slows down, the housing market slows down. That's all that's happening. It's not a collapse of the market. But for your folks that are flippers, you have to be a lot more cognizant of everything. Your labor costs, your material costs, all of that is going to play a role. Right.
And they're not hand in hand. In real estate taxes shooting up through the,
oh yeah,
oh my God. Right. I think we haven't felt the effect of the increase in the market hasn't been fully thrown into the real estate taxes yet. So, I don't know. Are we going to get nailed on real estate taxes as things kind of even out a little bit for a minute here, right?
Yeah.
Like, it's kind of a combination of a bunch of stuff that just makes you a little bit uncomfortable, right?
Right. So
and just that little bit of uncomfortableness makes people misinterpret the deep, nature of the information. And so then they, like I said, then they start to make decisions based on not being fully informed, and things happen. You know?
So I called for peak of pricing in the fourth quarter of 17. And, there's always this run up afterwards of pricing. And consequently, on average, home prices have probably gone up another 5-6% in that time frame, whether it's resale and or new construction. And that's kind of where pricing is going to come back down. So then you've got this buyer mentality.
What do you mean pricing's going to come back down? So I agree with you. So you mean it's going to come back down to that 5 or 6%?
Yeah, pricing.
That's what I think too. I'm glad to hear you say that, because that's what I feel. Just like I said, all I'm doing is touchy-feely stuff of being involved in everything day to day. So good stuff. Right.
Yeah. And if you look at so here's what the buyers need to understand for you folks that are out there.
Does that go for new construction as well, or just resales?
New construction is going to be, it'll lag a little bit further down the road. Only reason there is that we still have a severe labor shortage, and we're not feeling the effects of the lumber futures yet. Lumber futures, when Trump put in the tariffs on the Canadian lumber futures of, I think it was 10%. When he put in that lumber futures, maybe as high as 20% when he got done doing it. But lumber futures went from $320 a linear 1,000 feet to $640 in a 12-month span. So, and I may be bad at math, but a 10% tariff does not constitute a 100% increase in future lumbers. But that's what occurred. Lumber futures are back. They're on their way back down. The last time I looked, which was a few weeks ago, they were sitting at 420.
What's driving them back down?
Prices reach a peak like that, and then we get this flood of lumber that hits the market. So it's like any other commodity, and it's starting to work its way back down. And then you also start to hear, nationally about a softening in the housing market. Well, the softening in the housing market is simply due to interest rates. There are still so many buyers out there that are looking for houses that now simply just can't afford them because of what's happened with interest rates. And I think interest rates are going to jump up to 5.5% by the time we're done with the third quarter next year.
Wasn't there an article recently in the Seattle Times that said that rates that Fed's easing rates, and that they might? I thought I saw something about that flashing around. I didn't. Yeah,
they did tick downward just these last couple of days or weeks or so. I haven't looked within the last 7 days, but I did hear that they had ticked downward. I think in the grand scheme of things, though, I think they're going to peak at close to 5.5%.
A year from now.
A year from now, yeah. We have to create that secondary mortgage market. If you look at Freddie and Fannie's balance sheet, they're completely out of whack in regards to their working capital, in regards to their debt structure. So they have to fix that balance sheet. We have to. It
goes into my next kind of note here to myself is I heard somewhere that a 1% change in interest rates equates to a 10% reduction in buying power.
Yeah, and that's if pricing is stable.
If pricing is stable, right.
Yeah.
Well, so, I mean, if prices are going to come down 6%, then that actually helps buying power, right?
That will help buying power. And the other thing to keep in mind, too, is that the Fed rate is correlated, but not necessarily related to what happens with mortgage rates. We saw the Fed rate go up in 2005, but interest rates stay flat and drop down in 6 and 7. So they're not tied to one another in a marriage, if you will.
Hey guys, Joe here. I just want to take this super quick break from the action to let you know something that we have really cool to offer you guys. As you know, marketing is the lifeblood of our real estate business, and Julie and I spend a ton of money sending out postcards and letters to people all around the Seattle area. we've partnered up with YellowLetters.com to get you guys 10% off all of your marketing needs at Yellow Letters. All you have to do is go to YellowLetters.com, and when you check out, use the code Seattle Investors Club, and you'll get 10% off any of your marketing needs at YellowLetters.com. You can send postcards, letters, whatever it may be that YellowLetters.com has, so that you can keep your marketing engine running for a little less money. So go to YellowLetters.com, use the code Seattle Investors Club with no spaces, and get your marketing going today. All right, let's get back to the action.
So what are like the top three indicators? Be jobs, right?
Jobs, absolutely.
What else?
In migration. Without people moving here, you definitely cannot. You're going to lessen your demand for housing. And then for me, it's more of global economics. I start looking at the global economics down to the national and then into the local. And from the local standpoint, I will say this, that whatever the Seattle City Council does could potentially impact the rest of the Puget Sound. Simply because that's where our job growth is. So you have companies like Amazon that want their employees to live close to work, and then you've got the select few that are just anti-growth and anti-jobs, and that's Sawant and a number of other folks on the city council like her.
How did that happen? Jeez.
Well, you got too many people up there that don't necessarily want to work. No lie. So this was a news report that was televised in Portland probably 3 years ago. They interviewed a couple that had moved up here from Alabama or Arkansas, but they moved up to Portland because they loved the vibe, the kind of the hip, artsy-fartsy feel of Portland. Portland is just a really cool city.
Yep.
However, with the way housing prices were going 2 years ago, this news reporter interviewed them, and these people were heartbroken because she was a community organizer, he was a part-time musician, and worked part-time. And oh my God, now they both had to get jobs to afford rent and put food on the table. I'm sorry.
Yeah. Oh, boo-hoo.
But there are so many people like that. And they, and I'm sorry, they conjugate around Capitol Hill, and there's a lot of people up there that don't behave this way, but there's a big consortium of people up there that don't feel like they should have to work to put a roof over their head. It should just be provided for them.
We'll be watching everything closely. I think we need to talk more about that at the club, Joe, and, the city council issues and hot topic. But, yeah, Joe, you can be in charge of that one.
You got it.
But, okay. Hey, Todd, what do you read? Like, what publications or what do you read daily or monthly that might be of interest to us that we might be able to read aside from subscribing to maybe Metro?
To be honest, I read the Times. I read CNBC, Fox Business. I watch MSNBC, CNN. I watch Fox.
What about what's our local paper, the Daily Journal of Commerce?
I read that.
Yeah. If you had to pick your top two, what are your top two that or they all give such varied information? You got to collect it all and then sift it and see what falls out as somewhat accurate.
Yeah. And what's interesting is depending upon who you're reading, many have a tendency to omit certain portions of reality to their articles. And it's important, at least for me, to have it coming in from multiple sources. I can't say that I have one particular favorite. I just read a lot.
Right.
When I get home and I'm sitting in my chair, my wife's looking at me like, "What are you playing?" I'm like, "I'm not playing anything. I'm constantly reading economic news."
Any good books or any good things that you magazines or subscriptions that you subscribe to? These are all I see the Seattle Times and Daily Journal of Commerce. Are there anything else?
I behave more like a millennial in that aspect, where I'm constantly on the web just scouring different articles, whether the source could be in New York, it could be in Minnesota, it could be here in Seattle, just all across the board. I'll just punch in. So like take the bond market, for example, which is where my number one concern is. You type in inverted yield curve. And so every day I get multiple feeds now on inverted yield curves. So the problem that I found when I was just focusing on the Seattle Times or just focusing on CNBC or Fox Business is that's the only feeds I would get. So I've had to become more astute to widen my net in capturing that information.
I hear you. What another question for you? Are there? We were talking about Portland, and my daughter just dropped something. That's what you get for doing podcasts at home. Do you? What parts of the country lead versus lag the others? Like, does it happen in California first and we lag behind, and Portland lags behind us, or does it happen? Does the things tank in Florida first, and then is there any insight there? Because a lot of people in our Seattle Investors Club and a lot of the investors around the country that we, network with, I guess I would say, are very hot right now on investing in outside of their own market, right?
Yeah.
And so what can you tell us about, us, Joe and I, specifically, we are also invested in Las Vegas, which is doing nicely.
So Las Vegas surpassed Seattle just recently.
I saw that. Hey.
One market. Yeah.
Virtual high five, Joe. Yeah, good picker there. But so in general, though, are there kind of schools of thought of which regions lead, and as far as indicators go?
Atypically, it's California first, which then trickles up into Washington, which then trickles down into Oregon. The idea that Florida or Arizona.
Okay, go ahead. I was going to say, does the East Coast lead the West Coast, or?
It's been different on every cycle, I will say. Historically, it's been California first, but that's what's been driving this housing cycle is completely different than any other housing cycle. We are building less homes today than we were, say, in 1998, 99. And 1998 and 99 was not necessarily a housing boom, but you correspond what occurred after that with the dot-com crash, and then into 9/11, and then following up through the 2000s, where we had the mortgage meltdown. Today's environment is not a housing boom. Today's environment is a inventory issue. Part of it's created by the fact that we went through this massive downturn and wiped out the vast majority of our builder developers, and it's taken them years to work their way back into the fold. The other part of it is that we've got growth management that has not been addressed properly. The Puget Sound Regional Council expects the vast majority of our future growth to be vertical. They have not expanded the urban growth boundary, and they're expecting the vast majority of our future growth to be within cities of Covington, Renton, and Burien, and all these mixed-use complexes. Well, you can't build mixed-use complexes because you've got the condo defect litigation issue that carries on for about 12 years after construction. So nobody's building condos. It's not because there's no demand. It's that the cost to build them outweighs any value of buying one.
Right.
So we created this perfect storm ourselves.
Yep. We did that. But it's all not bad news, right?
No. To get back to your previous question, because I know I diverted there for a second. In this particular cycle, what is happening right now, outside of the couple events that we talked with, is the Chinese market as well. The Chinese buyers have essentially dried up. The Bank of China is starting to call loans across the country.
I work for a Chinese brokerage firm.
There you go.
Yeah.
From a corporate standpoint, some of the largest developers in Canada and in the U.S. Are getting their loans called by the Bank of China because China is going to start to head into a deep recession. Their GDP growth is GDP to debt ratio is off the charts. It makes the U.S. look like a child compared to what they're going through, let alone their demographics, because they had the one-child law for so many years. They have not replaced the aging population, so they don't have enough revenue to pay for the aging population. Their economy is on a razor's edge. I spoke with another economist earlier this year at the Master Builders Association. He believes that China may be requiring repatriation of assets and money at some point. He was talking about this in, I want to say it was February.
But what kind of projects are we talking about? We're not talking about people who own single family homes. We're talking about people we're talking about big, institutional type investments and stuff, right?
So right now it's big institutional. It's large projects. And I don't know the exact dollar amount, but the one investor that I have good friends with that I spoke with the other day, he was looking at a multi-billion-dollar portfolio that the bank called the loan on the investor or the builder. Chinese bank, Chinese builder. So he's out looking, he's scrambling for other monies right now. Mm-hmm. That's all I can say. I know more details on that. I can't speak about it. Now, from a logistical standpoint, it would be a nightmare for China to work its way down to the $1.5 million homeowner, have them repatriate those assets. I'm not saying it's impossible because they're a communist country and they're going to do what they do irregardless. There's nothing that the populace can do to stop the government.
What does that mean though? Because they're coming here with cash.
Right. They're coming here with cash to get their cash out of the country. So
but they're not borrowing from those, like the people buying $2 million, $1.5 million homes on Newport Shores are not borrowing Chinese bank money. I mean, I guess they might be borrowing it from like East West Bank locally here, but majority of them are putting a 5-year loan on for, 50% of the value of the house and in 5 years paying it out. And the only reason they put that on is because they're, trying to get the other half of the money out to pay it off.
Right. So when the other individual I was speaking with, the economist that brought this up, my initial thought was there's no way on God's green earth that's ever going to happen, that they get down to the individual homeowner that's pulled anywhere from $1 to $10 million out of the country to invest in a single family residence or an apartment building or whatever. Now, I'll just go to worst case scenario here as a what if. Okay. And with the Bank of China, which is a government-run banking institution, is now calling their large loans, before the construction's completed, they're calling that loan due because they need the capital. If they can't get enough of that capital, there is the possibility that they start working their way down through those individual investors that came into the country.
Right.
And now, this gets into opportunity.
Or what they do is whoever's got the project, what else do they personally own? And they go down their chain.
Yes. Now think of it from a communist country. Those that have that kind of money in China, the billions of dollars, they're going to bribe a few people to keep their billions, and then they're going to start coming after the small fish. Potentially. My brain, goes down worst case scenario. Now, worst case scenario is they do come after those individuals that have the $1.5 million to $4 million, $5 million homes. And they're going to make them sell those and repatriate that money. So all of a sudden, inside the Puget Sound, we've got all these high-end homes, which in Seattle and on the east side, I think equates out to about 15 to 20% of our overall market. All that inventory hits the market within a 24-month span. Now we're going to start to see huge depreciation in that high end, especially with where interest rates are and where those buyers have come from. primarily China.
Well, I think there'll be an indicator before all that happens, meaning that, I think people are still coming and buying, in other markets as well, because we have offices in other markets, but definitely I feel like it's slowed down. But I would say all that, anybody coming over here would dry up first out of fear of that happening.
Oh yeah. No, there are so many what ifs that need to occur for it to get to that point. But and again, it's not a catastrophic thing. What that does is that starts to create opportunity. So in this kind of recession that we're going to go into potentially, it's an opportunity. It's not necessarily, I wouldn't call it the end of the world at all.
I agree. I think that for our world and for the people that we talk to, all this change is really good for us because the way it was going was very difficult. And I think some sort of adjustment or whatever it is we want to label it is actually a good thing. And even for smart investors and savvy investors and probably builders, even bad news could be a good thing. I hate to say it, if you're smart and you stay on top of things and you are prepared to pivot and take advantage of what could happen, right?
Yeah. I would much rather have a soft landing than a hard landing 3 years from now.
Right. Well, we're getting long here, so I'm going to wrap up with just a couple more things here because I have two girls here that are anxiously waiting to get on the camping trail. I want to say, I feel like my big concern for some reason is that wage growth isn't matching up with everything else going on. And what do you forecast or what do you think about that? Real estate taxes are going up and, I still don't even understand the tax implications of the federal tax law changes and whether it's going to be good or bad for me. I'm feeling like it's not, like I'm caught in this middle spot. But what more so I worry about is, things feel like they're turning big box again, right? It feels like Amazon's going to buy Redfin and, Amazon continues to grow and these, for a while, everything's been taken over, buying up, Chinese buying this and that, and maybe that's changing. But what about wage growth? What's your comment about that? Is it going to happen? Is it not? It feels like you have to do higher volume at a lower price, not just in real estate, but in everything.
Yeah, it's going to be hard to say. The wage growth is not going to keep up with housing here in the Puget Sound. It's just not, because the Puget Sound Regional Council has limited the amount of inventory on the market, period. It's a supply and demand issue. You got demand for 2 homes, but I'm sorry, there's 1 house out there on the marketplace. It's just the way it is. Now, what will end up happening is
out here, then
sales will end up declining because we'll have fewer buyers that are going to be able to qualify, which then will give this perception of less demand, which is absurd. But that's just the way it is. You can't pay.
Or will it translate into maybe the condo market picking up?
The problem with the condo market is that condo defect litigation.
I don't mean new construction. I mean buyers. Buyers, I already feel like it kind of started happening where the buyer, because they can't afford the single family home, they're now buying more condos.
Yeah, but that's the same issue. There's an inventory issue there.
Okay, right. Fair enough. Right. Yep.
There's no inventory.
Which they're trying to confuse with all these up zones, like Crown Hill having the up zone, right? You got single family home now that's going to be 8 row houses. That's part of their solution idea, right?
Yeah, but those row houses are going to be at $1,000 a square foot.
Right.
Who can afford that?
Right.
Amazon. Well, wait, they're not hiring anymore. So there's just caution. You just have to be very cautious in regards to the buying. I run a report for myself every month, and it shows the percentage of buyers that are in that, that 2 million plus or that 1.5 to 1.75, and I rank it all the way down to 250,000. And the reality is that 50% of our buyers still are under that $550,000 mark.
So their sweet spot is under 550 still.
Yeah, and that number will drop down if interest rates continue to rise.
Right. But that's just good info,
Yeah.
That's just good info.
The idea, so for your folks, when they're going out and they're doing their comps, just to be safe, prices are not going to, I don't think they're going to drop 10%, but give yourself a 10% leeway on that. If you can't make it work, then just be careful.
Yeah, right. Yeah, exactly. I don't, you, that's what I think too. Like you should have some leeway that even if things come down 5 or 6%, that you're still okay. You just, you're not making as much money, but you can get out of it still. You're going to be okay.
Yeah.
Right.
Yeah, you got to have
I have noticed though, the further like north, for example, you go like Snohomish County, like far up, like north shoreline area has taken quite a, to me, it seems like a noticeable drop in single family prices. Because I think people are like, oh, wait, I was feeling like I was being forced to go up to shoreline and pushed further and further north. But now that things are adjusting, maybe I can come back in. But then that's a temporary pause, I think, right? Let me go back and look closer in. It only adjusted by 5%. I still can't afford it. So then it's just like a timing thing. Then they're going to go back, out there.
Here's part of the issue when you go up into shoreline or anywhere along that 99 I-5 corridor where the transit centers are going. In those geographical areas that had those upzonings, we had home prices go up by 200-300% in some cases. Now, the inexperienced realtors looking at a house that's a block away, and that one sold for $600,000. This one's worth $600,000. No, this one's still worth $350,000.
Right.
To the zoning, but they don't get that, nor do some inexperienced buyers that come in and pay those exuberant prices for those homes. And consequently, you can get hurt in those areas if you're not careful.
Right. Well,
let alone those geographical areas were pre-platted back in the 50s and 60s. And before you do anything to what seems to be a 1 acre, large lot, developable piece, you have to be very careful because that could have been platted and you'll have to get the entire neighborhood to okay whatever you do inside.
I ran into that on one of my own deals. Yeah. I ran into that on the restrictions and stuff like that, right?
Yeah.
It is a very good point for all you guys listening is that all those neighborhoods in Shoreline, for example, or wherever you're at, you need to check and make sure that there's not some sort of stuff that runs with the land from long ago that restricts or needs approval by everybody in the subdivision, right? I mean, people get spanked on that sort of thing if they're not paying attention, right?
Yeah, for sure.
Well, let's wrap it up with something a little bit lighter. Well, first of all, can we do a quick summary? Because we talked about a lot of stuff here. In general, we're saying, hey guys, don't panic, right? Things are not going to crash and burn. We don't think, right? Yep. Unless what if happens and China blows up, okay? So, but in general, right now, interest rates you think are going to continue to click up over the next year and maybe hit out at 5.5%, which will erode some buying power, which will, take some buyers out of the market because the wages aren't following. However, in general, buyers are still out there. Price adjustments might be 5 or 6%. Be careful about your buying. Pay attention. Be a little conservative, but don't panic. Is that where we're at?
Yeah, don't panic. I mean, the resale side of things, that sales are down 3%. That's nothing.
Right.
Homes for sale jumped by 20%. New listings jumped by 12% for the, I think these numbers are June numbers, but then I haven't looked at July's yet, and August aren't out. In the months of supply, just, if you hear numbers like the 41%, check those numbers and look to where they're really coming from, because and don't pay attention to too many of the articles because it's
right.
The reality is right now, as far as new construction goes, we have the lowest levels in the U.S. On the resale side of things, we have the lowest levels in the U.S. Out of all the major markets we track at Metrostudy, our inventory levels are at the bottom. And we still have in-migration.
There we go. Not so bad. Are there any other markets that you like outside of Seattle?
I do like, Las Vegas. There's still portions of Texas that I like. Florida is doing really well. I'd stay away from California. Any part of the country right now that really is fed by a lot of Chinese buyers. That I'm
That's
very standoffish
okay.
in that, those geographies right now.
That would be Houston. Lots in Houston. I can tell you because we have a Houston office. Woo.
Yeah, it's concerning.
Okay.
And it's just because of the government. You just don't know how they're going to react.
Okay. Well, let me ask you a fun question now, aside from all this real estate analysis. So what do you do for fun outside of work?
Well, being that I have 4 other companies and a 50-hour job, I golf whenever I can, and I fish whenever I can.
There you go.
Spend time with my wife and kids.
Golf, fish, family. Sounds good to me. Sounds so good to me that I'm ready to wrap up and go spend some time with my own family here. And my sidekick, Buddy. Everybody knows who Buddy is. Buddy's our dog.
Buddy's my dog.
Buddy's your dog? Oh, what kind of dog?
Well, it's my wife's dog. It's a Shih Tzu Bichon Frise.
Oh, cute.
My dog is, his name is Zeus. He's a Labrador and really, I'm going to forget.
Labradoodle?
Oh, Lord, no.
What do you mean? That's what I got. That's what our little boy over here, Buddy, is.
No, mine's a Lab Border Collie.
There you go. Well, that's a little tougher. Buddy is pretty much the biggest wimp, yet the cutest dog on the planet. We love you, Buddy. Buddy's going camping with us, so.
Well, you figure Zeus would be a tough dog, and he's afraid of our cat.
That's right, Joe. Pretty soon you're going to have to get a little sidekick to hang out with you guys, you and Emily in the van there. Someday, maybe. You never know. Could happen.
As long as they would, once we get through the national parks, we will definitely do that because they don't let them in the national parks.
Oh, really? Interesting. You hear that, Buddy? No national parks for you, boy.
Well, I will offer this up for you guys. I do probably 40 to 50 speaking engagements per year. If you guys ever get your people together in a room and you want me to come in and do one of these briefings and economic forecasts that I do for my clients and the master builders associations and so on, I'd be more than happy to come in and do that.
Awesome. Joe's going to hook you up because we get our people in a room once a month down in Renton at the Renton Technical College.
There you go.
We get a good crowd and you will be popular. So we book a few months out. So I'll let Joe and you hook up on that and we'll get you in. That would be fantastic. That would be fantastic.
Absolutely. And Todd, is there anything you'd like to promote while you're on the show here?
No, I'm good, guys. I appreciate it, though.
But the subscribers to Metrostudy, is that usually like companies or individuals? Companies. Okay.
Because the average subscription across the board is about $12,000 a year. So it's builders, lenders, appraisers, private equity groups, the bigger guys.
Okay. All right. Well, we look forward to seeing you down the road at Seattle Investors Club. Other than that, Joe, where can everybody find the information about today's podcast?
Yeah, guys, make sure that you check out the show notes at seattleinvestorsclub.com/47. That's seattleinvestorsclub.com/47. We'll have all the show notes there, as well as if you like this show at all, please, please, please give us a review on iTunes. You can get there quickly by going to seattleinvestorsclub.com/iTunes. For every 5-star review that we get, it totally helps us out to get our voices out to more people. So thank you if you've done that.
Thanks, guys. We appreciate it. And thanks, Todd, once again. I am going to sign off, and I hope you guys all enjoy, or by the time you hear this, I hope you've all enjoyed your holiday weekend here. And over and out. Safe travels if you guys are going anywhere. And as always, to you, Joe, wear your seatbelt. And I'll talk to you guys soon. Thanks, Todd.
Thanks much. Bye.
Bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.